Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, we're going to learn about money-ness of options. That is, what is in the money, out of the money, and at the money. And alongside that, we would also learn about the difference between intrinsic value and extrinsic value of an option. So here we go, let's get started. So let's take an example of a stock whose spot price changes with respect to the strike price. And let's say it's a call option. So it's a call option with a strike price of 203, which remains consistent. If the strike price is greater than the spot price, then this option would be called out of the money option. And again, the moneyness of options are derived from the point of view of the buyer of the option. Remember this as a thumb rule. Essentially what that means is if the strike price of this call option, I'm talking about call option here, is greater than the spot price, then this option would be called an out of the money option. If the strike price is equivalent to the spot price, then the option would be called at the money. And if the strike price is less than the spot price, then the option will be called in the money. Or you can loosely call it as a scenario where this option buyer is in losses. Here, this scenario means no profit, no loss. And in this scenario, this option buyer would be in profits. But this may not always be the case, so we cannot really generalize that. So we do not look at the profits or losses of the option buyer to determine the moneyness of the option. No, that's not how it works. You simply look at the difference between the strike price and the spot price. If strike price is above spot price, then this option will be out of the money. If strike price is below spot price, then this option will be in the money. And we're only talking about call option, because when it comes to put option, the scenario completely reverses. That is, if the strike price is above the spot price, that will be called in the money. And if the strike price is below the spot price, that will be called out of the money option. So in case of European option, the option will only be exercised if the buyer is in some kind of profit. This is what we had established. In other words, we can say that the option will only be exercised if the option is in the money, if it's a put option, as well as in the money if it's a call option. So only in these two scenarios, the buyer of the option would be profitable. He can also be profitable in the scenarios of at the money, but it depends upon at what price the option was purchased, right? And similarly, option seller would want the options to expire out of the money so he can get to keep the premium. Essentially what that means is the buyer of the option wants the option to go in the money. Whichever option that he would buy, he wants those options to go in the money. That is, if he bought a call option, he is expressing to the world that he has a bullish view on the underlying. And if he bought a put option, then he is expressing to the world that he has a bearish view on the underlying and he is expecting the underlying to go down. And exactly opposite would be the case for the seller. That is, if he has sold a call option, it means he is expressing that he is bearish and he is expecting this call option to expire out of the money so he can get to keep the premium amount. Or if he is actually selling a put option, what it means is he is bullish on the underlying and expire the underlying to not breach down the strike price so that he can get to keep the premium amount. This brings us to the concept of intrinsic and extrinsic value. So what are intrinsic and extrinsic value and why should we care? We should care about the intrinsic and extrinsic value because when you combine them both, that's how you arrive at the premium pricing. Premium of call option and premium of put option. So premium is nothing but the addition of intrinsic value and extrinsic value. So this time, let's take an example for put option. Intrinsic value is nothing but money-ness of the option. So for an in the money option, the intrinsic value would be greater than 0. Always. But if the option is out of the money, then the intrinsic value would be equivalent to 0. And even for at the money option, where the difference is 0, the intrinsic value will be equal to 0. But if we take an example where this put option is purchased on 01st of January and is going to expire on 15th of Feb, then you would see that there's roughly 45 days in between these two dates. And therefore, in these 45 days, this pricing dynamic can change drastically. Therefore, when it comes to pricing this option, you would add some premium amount for the time that is left in the expiry of this option and the volatility associated with it. Because the prices can keep fluctuating, so of course, the volatility aspect would also need to be added to the premium of this option. Let's say today is 15th of February and there isn't really much of a volatility left in the stock, or there isn't really much of a time left in the stock to make very wild move on either side. So what it means is, as we get closer to the expiry date, the extrinsic value keeps going down. The time would reduce and the volatility would also come down, right? Because how much a stock can move in a day? At max, say 1%, 2%, right? You don't really see wild moves on an asset for most of the days anyway, right? So as we approach the expiry, it's only the intrinsic value of the asset that remains in the premium pricing and the extrinsic value goes to 0. Therefore, on 15th of February, if this is an in the money option, its value would be $3 and the value of at the money option would be 0. And even for the out of the money option, its intrinsic value would be 0. Because the current price of this stock is $205, but if the buyer of this put option wants to exercise, he would only get $203 for his option, selling this underlying. So why would he want to sell his stock at a loss? This is a loss, right? If it is currently trading at 205, he might as well sell it in the market rather than exercising his put option to sell at $203, and therefore this option's intrinsic value is 0. Same is the case with call options. Out of the money options will have 0 intrinsic value. At the money, usually it's 0, and it's only in the money case where the intrinsic value is not equal to 0 and is actually greater than 0. So that's the concept of intrinsic value and extrinsic value. As we approach expiry of the option, the extrinsic value keeps going down and the premium prices usually only includes intrinsic value by then. However, if the intrinsic value is also approaching 0 because of the money-ness, then the premium amount would actually diminish and go all the way back down to 0, which is what the option writer wants. He wants the option to expire out of the money so he can get to keep the premium, and in that scenario the option would be called to have expired worthless. Why? Because the intrinsic value is 0 and so is the extrinsic value. So I hope this concept is clear. If it's not clear, just let me know in the comments about exactly what kind of query that you have, and I'll be more than happy to respond onto your comment.